All right, let's tackle a huge question for anyone even thinking about getting into real estate. How do you know if that rental property you're looking at is going to be a real wealth builder or, just a total nightmare? Let's figure that out together.
Look, we all get into this for the dream, right? You picture these consistent monthly checks just rolling in, building this amazing passive income stream, and securing your long-term wealth. But we've all heard the horror stories too. That nightmare of getting hit with unexpected massive repair bills, the property sitting empty for months, and your investment just turning into a giant money pit.
So that's the million-dollar question, isn't it? How can you possibly tell the difference before you're locked in? Well, that's exactly what we're going to break down right now.
Here's how we're going to do it. First, we'll get clear on what actually makes a rental profitable. Then, we're going to uncover the four different ways a property can pay you. After that, we'll get our hands dirty and run the numbers on a real-world example. And finally, we'll figure out how to answer that big question. Is this actually a good deal? Okay, first up, let's talk about the absolute foundation of any good real estate investment. It all boils down to one simple core concept. And that concept is cash flow. It sounds fancy, but it's really simple. It's just the money that's left in your pocket after you subtract every single cost from the rent you bring in. If that final number is positive, congratulations, the property is paying you. If it's negative, well, it's costing you money every month to own it. It's really that straightforward.
But here's where it gets really interesting. That monthly profit is just one piece of the puzzle. A truly great real estate investment is actually building your wealth from multiple directions all at the same time.
Think of a solid investment like a sturdy chair with 4 strong legs. You've got your monthly cash flow, of course, that's leg number 1, but you also have the property's value going up over time. We call that appreciation. Then there's the loan paydown. I mean, every single month your tenant is basically buying you a piece of that property, building up your equity. And finally, there are some pretty awesome tax advantages. A really great deal delivers returns from all 4 of these pillars. All right, enough theory, let's make this real. We're going to walk through an actual example step by step so you can see exactly how these concepts work in the real world. So here's our case study, a single-family home in Memphis. It was bought for $155,000. The investor put down 20%, which is $31,000, and then paid about $4,000 in closing costs. So the total cash out of their pocket to make this deal happen was $35,000. Now remember that number, $35K. It's going to be really important later on. Now, to find our real profit, we just have to follow these 5 simple steps. We'll figure out our realistic income, subtract all the real-world operating expenses to find something called net operating income, and then we take out the mortgage payment to get to our final, true monthly cash flow. Okay, step 1, let's figure out our real income. The house rents for $1,300 a month. But here's a pro tip. You never ever assume you're going to collect rent 12 months a year. Stuff happens. Smart investors always budget for vacancy. A safe bet is about 5%, so we'll subtract $65 a month. That gives us what we call an effective gross income of $1,235. Now for the most critical step, and honestly, this is where most beginners go wrong: operating expenses. This is not just your mortgage. This includes property taxes, insurance, and property management fees. But crucially, you also have to set money aside for everyday maintenance and for the big stuff. The new roof you'll need in 10 years, or the HVAC that's going to die eventually. We call that capital expenditures, or CapEx. Forgetting these costs is how a good deal on paper turns into a disaster in real life. Okay, so for our Memphis house, when you add up all those operating costs, your taxes, insurance, management, and setting aside money for repairs, it comes to about $568 a month. So we take our effective gross income of $1,235, subtract that $568, and we get a net operating income, or NOI, of $667. Think of this as the profit the property itself generates before your loan is even part of the equation. And now, the final step, the moment of truth. We take that net operating income of $667 and we subtract the actual mortgage payment, which is about $301 for the principal and interest. And that leaves us with our final, before-tax, cash flow number. And the number is a positive $366 a month. So after every single predictable bill is paid and money is set aside for future problems, that is the actual cash going into the investor's bank account every single month. Okay, so we have our number, positive $366 a month. That's great, but is it a good deal? See, getting the number is only half the battle. Now you have to know what it means. I mean, a positive number is obviously what we're shooting for, but how do you measure the quality of that return? Is making $366 a month a good result for that $35,000 in cash we had to put up? How does this stack up against, say, just putting that money into the stock market? This is where a super powerful metric called the cash-on-cash return comes into play. It's a simple but brilliant formula that tells you exactly how hard your invested cash is working for you. You just take the total cash flow for the year and divide it by the total amount of cash you put into the deal.
So let's do it for our Memphis property. Our annual cash flow is $366 times 12 months, which is $4,392. Then we divide that by the total cash we invested. Remember that $35,000 number? And that gives us a cash-on-cash return of 12.5%.
So is 12.5% any good? Well, to give you some context, a lot of savvy, experienced investors are aiming for a cash-on-cash return somewhere between 8% and 12%. So by that yardstick, a 12.5% return is looking really, really strong.
But, and this is a really fascinating bit of nuance, not every great long-term investment has positive cash flow right away. In some really hot markets that are appreciating quickly, an investor might actually choose a deal that breaks even or even loses a little money each month. They're playing a different game. They're betting on appreciation. They might lose a few bucks every month, but they're hoping the property's value goes through the roof. As one source puts it, short-term negative cash flow doesn't mean it's a bad investment. It just means it's still maturing. It's a strategic choice. At the end of the day, this whole analysis, it isn't just about crunching numbers on a spreadsheet. It's about taking control. It's about making smart decisions and building a real plan for your financial future. So, the only question left is, are you ready to run your numbers